these numbers are showing bearishness that you typically see after like an 18-month, 40% decline. I was like, we're like 11 days off the high, and we're down like 7%. And people are acting like they've just been completely wiped out. And they haven't been completely wiped out. They've gotten themselves worked up into a froth that this is the end of human civilization. That's what's been a little bit surprising about this.
Jim Bianco, president of Bianco Research, coming to us from California today. Jim, it is so great to see you again. Great to welcome you back to the show. We always love having you on. Thanks again for taking the time.
Thanks for having me. Looking forward to the conversation.
I am too, because I got to say, Jim, you have been killing it on Twitter. Matt and I were just talking about that. I feel like all of your threads lately have just been so spot on. So for folks watching and listening, definitely go follow Jim on Twitter. But Jim, it's been a while since we had you on. I can't even remember. I know it was toward the end of last year. Maybe it was right after the election. But gosh, now that we're 2 months into Trump 2.0, a lot's been happening in the markets, a lot of chatter about where's the economy headed. So let's kind of step back, as we always do, and do the big picture, where we are today, more of that macro view. And as you know, Jim, you can take all the time you need to set the table.
The economy seemed to be at the top line doing okay. It was before the election, despite the 10% correction in stocks and all of the hand-wringing that we might be having a recession now. I do think it's still okay, but I think there's an important distinction about the top line being okay. It's what economists call K-shaped, right? That the bottom half of income is not doing as well relative. Now, of course, to the bottom half of income, I don't expect them to do as well as the top half, but you can measure it on a relative basis. They're not doing as well as the top half of income. What's been the big difference between the two? Inflation. That the inflation rate has taken prices since the beginning of 2020, I'm going with the end of COVID, to now up about 25%. So if you haven't gotten a 25% raise, you haven't kept up with inflation. 54% of the public, according to a Bankrate.com survey, says they cannot come up with $1,000 in an emergency. So if their hot water heater breaks or their car stops starting, they have to borrow the money on a credit card or from a friend. Those people usually rent, and they have no assets. So they're dependent on them getting a raise to keep up with the cost of living. And largely for the last 5 years, they have not gotten that. Top half of income, I could actually say the same thing about the top half of income, right? That they need their salaries to go up in order to keep up with with inflation. But maybe at the top half of income, even though they make more money, that hasn't happened. But three big things. One, they have a lot more disposable income because they're in the top half of income. So they have extra money to spend. Two, Redfin or Zillow tells them their home, which they own, goes up in price. And three, they own a portfolio of something, crypto, stocks, something, that's gone up in price too. So as I like to say, the biggest difference between the bottom half of income in this environment now and the top half of income is they go to the grocery store to buy some eggs. And the bottom half of income says, well, if I'm going to buy these eggs, I can't buy something else. And they have a 4-letter word that they mutter under their breath because of the decision they have to make. Top half of income goes to the store, sees the price of eggs, mutters that same 4-letter word, and then they just buy it and move on with their life. And they don't have to make another hard choice along the way. And so that's the biggest difference in the economy. And that is important to really discuss what's going on, because the bottom half of income, that 54, 55% that cannot come up with $1,000 in the savings, they put Trump in the White House. And they are demanding something in return for that. And by the way, that demand is not another 20% in the S&P because they don't own it. That demand is they want their jobs back. They want their lifestyles back. They want prices to come down so that they can afford the necessities of life. And that seems to be a big driver behind, I think, the Trump administration's policies that we've seen over the last 2 months.
Mm-hmm. So it sounds like it might be intentional as well, because I mean, when you listen to Treasury Secretary Scott Bessent, he talked about, the economy and this need for like a detox, also pointing out that like the top 10% of income earners are accounting for what was it, like 40 to 50%?
50%.
Yeah. So do you think that's the realization there? And is that what we're also seeing kind of, maybe that short-term pain in the markets, if you will?
Yeah, I think, first of all, what we're talking about is a recent Fed study came out that the top 10% of income, 10% of the public, accounts for 50% of retail sales. So that half of all the spending in the country comes from 10% of the people. And that's the most concentrated it's ever been. And that's because of years and years of asset price appreciation that has basically papered over a lot of the ills that we've had. And it's also created the partisanship in this economy and, the difference with the K-shape. The detox that he's talking about is why did the top 10% get so wealthy? Money printing, zero interest rates, accommodative policies, all designed to push up asset prices. And that is what he was arguing is the problem with that is it's put us in debt. It's given us the big deficits and it's given us a lot of other problems that we've had. And that's what we have to detox ourselves from in order to get this economy back. Now, they have shifted their focus to the 10-year yield, that they defined the successful policies, 10-year yield falling as opposed to the S&P going up. That's part of the same thing, that they're not just trying to cater to the wealthy. So what is it that is underlying driving all of this? And that is a simple question. Were we going into the election? Were we on the precipice of a crisis? A crisis of we have too much debt. We have too much borrowing. We have the dollar is in a precarious position. Chairman Powell in December gave a speech and said the fiscal situation in the United States was unsustainable and said we had to change it. So the Trump administration comes in and says the status quo cannot hold. We cannot keep doing this. We have to try something different. So there's trying something different is involving tariffs, trying to bring down the value of the dollar against our trade partners in order to make, say, manufacturing, heavy industry jobs more competitive, trying to get more of those. And look, it may not work. I understand it might not work, but I understand what they're trying to do. It's also a belief that we have $36 trillion of debt. Where did all that debt come from? What was the biggest driver of that debt? Maybe the last 70 years fighting communism and then terrorism and protecting the free world and keeping the shipping lanes open, while Europe, South Korea, Japan has not had to pay for any of that. And now that maybe the bill is due, that it's time that they step up and start paying for this. That's why this demand that there be defense spending in Europe, this Mar-a-Lago Accord about that swapping debt for treasuries, this idea that's just a payment mechanism has come along because the status quo can't hold. So let me conclude with this idea. A week ago, the cover story of The Economist magazine was a picture of Trump with a can of gasoline and a lit dollar bill about to set the world on fire. And the premise of it, it's The Economist, it's UK, it's very European centric with their view is just stop, just stop with this stuff. And I would argue that if Trump were to come out during our recording and say, you know what, I've had a change of heart. No more tariffs. I'm done with tariffs. We're done with that. We're not going to talk about it anymore. I just fired Elon and Doge. They're out the door. We'll go back to $7 trillion budgets, $2 trillion deficits. Here's a blank check for the Ukraine. Whatever they need to fight Russia, we'll just give it to them, open-ended. What would be the response? That was where we were 4 months ago. What would be the response? I think the bond market would collapse on that news. You're going to borrow astronomical sums of money. We're going to drive interest rates through the ceiling, and that would prevent stocks and crypto and everything else from rallying. So the argument is there is no going back. We have to move forward with these big realignments we're doing. You could criticize Trump, and I have my criticisms about a lot of the things he's doing, but then you have to say what it is we would do in place of this, because always the criticism is this policy's bad. Just stop. Just do what we were doing 6 months ago and we'll be better. I'm not so sure that's the case anymore. We can't just stop doing this and just go back to giant deficits and, rampant government spending and all of the other problems that we've had and just borrow into infinity. So that's where we're at right now. We're in a major realignment is where we're at. And then finally, I'll say something that, is a little controversial, right? When we need to pay off this debt, we need to, or if not pay it off, bring it down. Where are we going to get the money to pay this? Now, the typical answer is we got to tax the rich. We've been trying that for 60 years, and that's how we got to this point. And the rich don't have enough money, but there is a bigger pile of money than the rich in the United States. It's everybody else in the world. And that's what this whole defense spending is. You, Europe, you, Japan, you, South Korea, you're going to pay this. And we're going to give you a bill for security to pay this. And that's not different than what we've seen major powers do throughout human history. Whenever they get over indebted and they get into trouble, they usually invade their neighbors and plunder them. Well, we're not invading anybody. We're not plundering anybody. We're doing the 2025 version. We're sending them a bill. That's what we're doing. And we're saying, here's a bill, pay it. And so that's where the money is to get us out from underneath this debt problem. It's in Europe. It's in Japan. It's in South Korea. It's in Mexico. It's in Canada. And that seems to be the policy that we seem to be going for. So I understand why the Economist magazine's hopping mad. I understand why they're seething about us in Europe, because we're asking them to do something that they've never had to do before.
Yeah, we're as you point out, we're going through a major realignment. One of the things that you've brought up lately, and we have not discussed it on this show, but you've talked about a Mar-a-Lago Accord. Is that also, is that part of this realignment, or is that something totally separate?
It's part of it. It's part of it. Now, to be clear, where the word comes from is it's a riff. It's a riff on whenever there's been a major realignment, like a currency accord and stuff like that, they usually name them after the hotel or the resort where they were made.
Yeah, like the Plaza Accord. Yeah.
The Plaza Accord was 1985. It was the Plaza Hotel. Bretton Woods. A lot of people don't realize, where did the word Bretton Woods come from? It's actually still a resort in New Hampshire. And that's where in 1944, they came up with the currency realignment after World War II. So the Mar-a-Lago Accord is not a thing. It's just a riff on that word, that when we have a major realignment, we name them after like the hotel or the resort where they're made. And while there isn't a formal meeting going on at Mar-a-Lago, it's where Trump lives, and that's where the name comes from and stuff. So that's what we're talking about. And it came about in a report written by Stephen Mirren, who's the Council of Economic Advisors. He wrote it right after the election in November about restructuring the global financial system, about the idea of bringing the debt levels down, and about payment for security. And that's what we're starting to see. Now, what's happened with the Mar-a-Lago Accord is there's one specific part of it that's gotten everybody's knickers in a twist. And that is this idea that we're going to tell Europe that they've owned trillions of dollars of U.S. debt. You're going to give us that debt back, and we're going to give you a 100-year zero coupon bond, which has a value of about 13 cents. In 100 years, it'll be valued at $1. And that's a way of us extinguishing 87% of the debt. And consider payment for security. You're going to have to pay for security. Well, you're not going to write me a check for $2 trillion. You're going to give me $2 trillion of debt, and we're going to give you this zero coupon bond. All that is a payment mechanism. That's like you and me agree. I owe you money. So how am I going to pay you? Am I going to write you a check and mail it to you, or are we going to Venmo it? That's all that is. It's just a payment mechanism. Now, Europe has agreed that they're going to pay. But the way that they've agreed they're going to pay is they say they're going to spend billions, if not $3 trillion, or 3 trillion euro to float the idea. It's about $3.2 trillion over the next decade on defense. That's what they say they're going to do. So they've agreed that they're going to spend $3 trillion on defense. Now, if it happens and they buy tanks and they buy guns and they pay soldiers, they could go around the world shouldering the burden of fighting these wars and keeping the world safe. We don't have to. The great example of that is the Ukraine. That, Trump we're out. I'm going to talk to Putin the day we're talking. He's going to talk to Putin the next day, Tuesday, tomorrow. We're talking on a Monday. And they're going to talk about a peace accord. And Europe is all got themselves in a twist about that he's caving to Putin and stuff like that. And Trump has said, and Marco Rubio, the Secretary of State, has said, fine, you guys write some checks, ship them some tanks. You do it. We're not going to do another penny for it. It's your problem. You do the whole thing without us. And then Europe said, whoa, hold on a minute. We don't have enough stuff. We need the U.S. To do it. So this is about a payment mechanism, all designed for what? We have too much debt. We have too big a deficit. And part of the Mar-a-Lago Accord, or the Muir and restructuring argument, is the debt in the United States, the deficit in the United States, has transcended economics. What do I mean by that? When you want to talk about the debt and the deficit in the United States, you don't bring in the Commerce Secretary, Hart Lutnick, and you don't just bring in Scott Bessent, the Treasury Secretary, and go, what are we going to do about the debt and deficit? You also bring in the Secretary of State, Marco Rubio, and you bring in the Defense Secretary, Pete Hegseth, because it is in their interest that we get the debt down. It is a national security problem, the amount of debt and deficit that we have. What is the driving force behind that? The economic historian Neil Ferguson wrote an essay in the Wall Street Journal about 2 or 3 weeks ago, quoting another Ferguson, Adam Ferguson, no relation, 17th century Scottish economist. Adam Ferguson, 250 years ago, noted that whenever a great power spends more money on interest expense than defense, they stop being a great power. And Neil Ferguson went through 250 years of all the cases that's happened, or when you spend more on interest expense than defense, you quickly reverse that and you still remain a great power. So whenever you hear Elon Musk defend what Doge is doing, the first thing he says is, we spend more on interest costs than defense. We cannot continue to do this. So really, it's almost like to the Treasury Secretary, to the economists, to all of us, everybody push out of the way. Let's bring in Aaron Pricks from Blackwater, and let's bring in all the defense people. How are we going to fix the problem of our debt? That's the level of crisis it's gone to. It is a national security issue. Now, you may disagree with that, but Trump got 81 million votes. He believes it. His advisors believe it. And that's the way that they're going about doing this, which is why they're being so aggressive with Europe. Well, we got all this trillions of dollars of defense debt spending that we've done. We've done it on behalf of the rest of the world. The rest of the world owes us. That's their argument, is what they're trying to do. And the rest of the world is where the money is. Going back to the status quo, and let's argue about raising the marginal tax rate on people that make over $400,000 a year. That shit don't work anymore. And so they're trying something different. You may not agree with it. And look, like I said, there's parts of it that I don't agree with, but this is what they're doing. And this is what the realignment is all about. And we'll find out in 2 years how it works out. But it is bold and it is a big initiative of what they're attempting.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. And I don't recall this conversation ever being as pervasive as it is today. I can't recall a time when it was.
No, it wasn't. And I think you had a confluence of two things happen, right? Confluence one is you finally gotten to the Neil Howe fourth turning type of argument. Yeah. We're there. We're in the fourth turning. In other words, when I say the status quo can't hold, that's the fourth turning argument. And if you want me to put this in fourth turning arguments, if Trump pulls this off, we're going into the first turning is what we'll wind up doing. We'll end the fourth turning and wind up going in.
Or I think that's the spring, yeah.
Yeah, that's the spring. Fourth turning is the winter. We'll go back in the spring if he's successful. So we're at that point. You had a president, we haven't done this 150 years, that stopped being president and then ran and won again, a non-consecutive term. What did Trump do in those 4 years in between? He did a lot of things, but one of the things he did was talk to people like Bessent and Lutnick and Mirren about what it is we need to fix this country about. And so all of the policies and all of the people that he has appointed were not like the first Trump administration. How did we get, famously, how did we get Jay Powell? Trump turned to Steve Mnuchin and said, Steve, I need a Fed chairman. And Steve said, I know this guy named Jay. He's already on the Fed. He's a good dude. Okay, fine. We'll make him the Fed chairman. And then Trump hated the idea of Powell as Fed chairman and kept criticizing Mnuchin for years on end. You gave me the name. It's your fault that Jay Powell's in there. He didn't think this stuff through, is basically what happened. But now he's thought this through, and he's got people that believe this vision. The vision is we're in the fourth turning. We are at a point where, like I said, going back to The Economist magazine, just stop. Stop doing what? Go back to where? And what do you think happens if, like I said, if he announces right now, I am ending all the I'm ending all the tariffs, I am ending Doge. What do you think I think the bond market collapses on that news, because that means astronomical borrowing and interest rates go sky high. So we have to go forward with this. Now, so that's why I said the argument is you can criticize him and you could say he's doing it wrong, but you can't just stop there, because usually you could say, just stop, go back to where we were. We can't. So what do we do in its place? And by the way, saying tax the rich and cutting the deficit through baseline budgeting, that's the shit that got us into trouble in the first place. That is the status quo. And so we have to try something different. And that's what this is about. It is a realignment out of necessity, out of a president that thought about this for 4 years, not being president, and lined this all up. That's why he had 250 executive orders ready to go in the first 50 days, because he's been thinking about this stuff for years on end. And so that's why we're seeing what we're seeing right now. So like I said, like it, hate it, think some of it's good, some of it's bad, it's happening. Mm-hmm. And I'm in the camp that the status quo cannot hold. Like I said, we just can't go back to $7 trillion. Okay, I get my numbers right. $7 trillion budgets and $2 trillion deficits. And let's go to 40 or 45 trillion in borrowing and just continue on that path. We can't go back to that. We have to go back. We have to go forward to something else. And this is the path that they've chosen. The big pot of money to pay this off is outside this country in the form of security payment. We've got to use trade deficit. We're going to use tariffs to try and bring down the value of the dollar to make manufacturing and industrial, heavy industry and the like more competitive in the United States, to bring back those jobs to people in the lower half of the K. Because if you don't have a high education, what's your path to a six-figure job? It's usually manufacturing, heavy industry, or construction or something like that. We need more of those types of jobs. And that's what he wants to bring back into the United States. Like I said, you can argue it's not going to work. Okay, it's not going to work. Then what do we do in place of that? We have to do something. We cannot just go back to the place that we were before.
Yeah. And as you point out, if you go back to where you were, that would just break the bond market. And Jim, I know you as a macro researcher, but I also know that fixed income is an area of expertise for you. And I am curious, are there things that folks get wrong when they look at the bond market? Like just common things, like misconceptions that you observe as someone who understands this space deeply, that maybe you see play out? And I don't know whether it's in the financial media or on social media, just, things that folks get wrong about the bond market.
The level of interest rates, so I have been one that argues that we're in a long-term bond bear market. And the immediate response is, oh, well, then get your money, run away from bonds as quickly as possible. Yes. But now that we actually have a coupon yield, a yield, and I'm talking about all in mortgages, corporates, treasuries, and the like, of around 5%, the bond market can return you something around 5% in a bear market. Some of the years you will have prices go down. So you might get your 5% coupon and maybe a 2% or 3% loss, and you have a 2% return. That was last year. But then the coupon might go to 6 or go to 5.5. And then the next year you get a bigger coupon and prices might go up and you might get some capital gains. So you might get a 2% return one year, an 8% return the next year, and you'll average about 5 over a long period of time. And that, I've argued, is a very attractive investment. Why? Because if you look at stocks, well, stocks go up 20% all the time. And, and AI and everything else is driving, the Mag 7 is driving all this stuff up. Yes, but now we've gotten stocks to such an overvalued level that historically, from these levels of PE ratios and market cap to GDP, Shiller-Cape ratio, whatever is your favorite metric, you should be looking at long-term returns over the next several years. The stock market will return you about 6%, maybe 7%. Now I'm talking about like the S&P 500, a 5 or 6 or 7% return. Bonds are going to return you 5 with less volatility. A bad year will be +2, a good year will be +8, and they'll average 5. Stocks will return you 6 or 7, but a bad year might be -10 or 15. A good year might be +25, but they're only going to return you 6 or 7, I think is where we are. So in the bond market, what I'm trying to say is that coupon matters. Now, 3 years ago, 4 years ago, the coupon was 0 in the bond market, or 1%. And we had to go from 1 to 5. And that was horrible for bond investors. It's one of the worst periods ever. But now that that's behind us and we're at 5%, that yield in the bond market is very good. Let me give you another quick analogy about the stock market. 6 or 7%. But there'll be opportunities for others. I like to use the analogy of sailing, and I'm not a sailor at all. But if I'm in a sailing boat and there's a 20% or 20 knot wind, all I got to do is get my damn sail up in the air and my boat's going forward. And that's buying the index and cheering for the S&P to go to 7,000 or whatever big number that you want. There's a 20 knot wind, just get the sail up in the air, buy the index. But if it's only going to be a 6 knot wind, 6% return, then I got to learn to tack and I got to learn to trim. Can I get the boat to go forward? Sure, but it's a little bit harder. It's a little bit more skill. I think in the next several years, just buy VU, which is the Vanguard S&P 500, or SPY, buy the S&P 500, buy your triple Qs. There you go. You're done. You're done. That might not be very fulfilling because especially the Mag 7 stocks are so overvalued, they could correct and the indexes might do nuts. But there might be opportunities in European stocks, small cap, maybe in financials, healthcare, energy, maybe in active management. That's a little bit difficult. That's a little bit of a different skill set. And if you did that right, you can actually earn a little bit more. But problem is, nobody does that anymore. The stock market is, two stocks. It's SPY and it's QQQ. That's all it really is. And what I'm saying is, it's not going to be terrible. There's going to be opportunities, but it's not going to be SPY and QQQ. It's going to be other things. And there's thousands of ETFs out there that you can take advantage of those other opportunities. And it's going to be, I can envision a period in the future where people are back to talking tickers again. We haven't had a need to talk tickers for a long time because the only ticker was SPY. The only ticker was triple Q, that we had to talk about. And the bond market will be at 5% with low volatility. It's basically going to give you most of the stock market's returns with less volatility. So it's a very different animal than it was when we used to scream Tina. There was no alternative. Everybody had to get into stocks. There is an alternative now.
That's
in bonds.
interesting.
And again, the key is there's a coupon. There's a 5% yield that it's going to churn out year in and year out. And that is changed the dynamic of the bond market a lot.
And so that doesn't mean like the 60-40 is dead either. Maybe the bonds attribute more?
Well, it's dead and it's not dead, right? It's dead to the extent that people used to view the 60-40 portfolio as why did we own 40% of our portfolio in bonds in 2019? It was crash insurance. You own 60% in stocks because that was the zero interest rate world where we were money printing and we were pushing prices up 15 or 20% a year. The S&P 500 would go up 15% a year. So get 60% of your money in stocks, they go up 40% of your money in bonds, because what happens when stocks wobble? We get a risk-off rally. Bonds are crash insurance. Today, you're looking at owning bonds because they're a low beta version of the stock market. The stock market is not going to be this runaway train of just making disgusting money here and there just by owning broad indices. But bonds will become a low beta version for a lot of people that might be listening to this call, depending if they have less risk tolerance. They might be saying, I could get 80% of the stock market's return with 30% of the volatility, down up 2, up 8, up 2, up 8, average 5, where stocks might be, up 15, down 15 or something like that, averaging 6, I'll take the bond market. I'll take most of it with less volatility. And so it does become an alternative for some people. And you see that because the bond ETFs are setting all-time inflow records right now because of that yield. People are saying, thank you very much. I'll take that yield and I won't have to worry about the gyrations in the stock market. Mm-hmm.
So maybe as it relates to the market, get used to maybe, as you point out, 6 to 7%, probably what Jeremy Siegel, I think in his book, Stocks to Long Run, said it was 8% was the average return for equities. Don't get used to these 20% gain type of years. Maybe that's behind us.
Yeah, and in Siegel's book, Stocks for the Long Run, the average is 8 or 9% over the long term, but that's assuming a neutral-ish valuation. We look at valuation in the stock market, and people will quip, well, valuation's a lousy timing tool. Yeah, because it's not a timing tool. That's why it's a lousy timing tool. But it is an expectations tool. When you buy stocks with a 25 or 30 PE or higher, what you're expecting in the future is either ridiculous number of earnings that they're just going to make money like you've never seen, or low returns. And when you buy an index at those high levels, it's going to be really hard for the stock market to produce, or for the economy to produce those type of earnings that these companies can make that much profit to justify those valuations. Because actually, if they did, the economy would be smoking along so hot, you'd probably have inflation and much higher, sky-high interest rates at the same time to act as a brake. So typically what you wind up doing is when you look at high valuations in the market, you'd say over the next several years, you're going to get much lower returns. That's 6. So yeah, you might average 6% over the next several years. And by the way, what Siegel will also say in his book is, what is the long-term earnings growth in the economy? It's about 9. So a decade of stocks returning 6, earnings growing at 9 will correct the valuation. So that's how you wind up correcting the valuation over time. So it's going to be at the index level, it's going to be a struggle, but look at European stocks are on fire right now. So there'll be opportunities away from just buying the index to make money.
Yeah. How problematic has that passive bid been? This is a topic that's come up multiple times on the show with, Mike Green, Harold Bradley's another who's brought it up, Bill Fleckenstein, the passive bid in the market.
I think it is a big problem, the passive bid in the market right now. One of the things that concerns me, concerns Mike Green and Bill Fleckenstein, I've talked to them about it as well too, is the idea of capitalism is supposed to be taking money away from good ideas, from bad ideas, taking money away from bad ideas and giving it to good ideas. But when you have indexes, just get your ass into the index and everybody gets money. And everybody goes up. Even if you mismanage your company, you still go up. If you do a great job of managing your company, you still go up. Now, the market discriminates a little more than that. The better companies go up a little bit more. But we're not punishing the bad companies, and we're not really rewarding the good companies to the extent that they should be rewarded. And so that passive bid is a problem. Now, maybe in the future, what I'm arguing is that passive bid becomes a little bit more active. It's not that the ETF blows up or anything else. It's that you shift away from VOO, SPY, and you start thinking about alternative energy, or you start thinking about regional banks, or you start thinking about Europe, or you start thinking about some of these other type of ideas, and you start buying ETFs that are structured for that. Now, you might say, that's too hard. I don't know enough about that stuff. I don't have time to look that up. One of the fastest growing parts of the ETF space is active management. Cathie Wood is famously for the ARK funds being actively managed funds. Now they're in, transformative technology, but you might see more traditional managers come into active management. And in full disclosure, we have an index that there's an ETF attached to, and we're in the active management fixed income side. I like the idea that 5% is where I should be in bonds, but I don't really know how to invest in bonds. Active manager. Give it to a professional manager. It's an ETF. It's as easy as buying Microsoft is where we're going to go. So that the structure of the ETF will remain, but the buying of just the passive indexes hopefully will dissipate into much more nuanced type of stuff. And if it's too nuanced for you, active managers are the way to go down that line. And I think that would probably be a better idea, because then we'll get back to the premise of capitalism. If you got a good idea, you get money and you get rewarded. And if you got a bad idea, we take it away from you and you're punished. And we're not getting as much of that as we used to get.
Okay. So let me ask you this about the markets then, like with the sell-off that we have seen this year. I know today that their stocks are on the rise, but I take it probably didn't surprise you, did it?
No, it didn't. I mean, we had 2 great years in the stock market, plus 25% or plus 20% returns and 25% last year. So we're due for about every 18-ish months for a 10% correction. The last one was October of 23. That's about 18 months ago, close enough for government work. We had an 8% correction in August. We had a 10% correction as of recording right now in this market. So no, it wasn't shocking that we had that kind of correction. What was shocking, though, I would tell you, is the reaction to the correction. I mean, I look at a lot of the data like, investors' intelligence and some other measures, the AAII survey of individual investors. And these numbers are showing bearishness that you typically see after like an 18-month, 40% decline. I was like, we're like 11 days off the high and we're down like 7%. And people are acting like they've just been completely wiped out. And they haven't been completely wiped out. They've gotten themselves worked up into a froth that this is the end of human civilization. That's what's been a little bit surprising about this. Typically on these type of corrections like August, first of all, it's hardly news. And second of all, if it is news, it's people saying it's a great buying opportunity. Not that, the world is coming to an end. Not that we have to have Scott Bessent come on Meet the Press. We're recording on a Monday. He was on the day before, where Kristen Walker is almost salivating. Oh my God, the stock market's down. Is this it? Is this it? Are we going to have a recession? Is human civilization going to end? Would it be better if an asteroid hit us? I mean, basically that's almost what they were trying to hyperventilate to him about. I'm like, we're down 9% and we're starting to act like that on the stock market. So that's the part that's been surprising, is the complete overreaction to such a move.
Yeah. Okay. So I kind of wonder too, like seeing the prices come down. I'm just thinking like asset prices in general. Like I'm in that camp. Like I would like to see, oh gosh, this is so terrible to say out loud. I'd like to see housing prices come down. I'd like to see all sorts of things come down for like entry points, or maybe that's a horrible thing for me to like wish, but
no, it's not a horrible thing, because for every buyer, there's a seller. I would like to see home prices come down, right? Well, that screws all the people that own homes. What do you have against them? I'd like the people that don't own homes to be able to afford one. That's really what that's what it is offering as an idea. So yeah, there is a equilibrium price out there for all this stuff. And if we get on the wrong side of that equilibrium price, we price people out of homes. Well, bringing those prices down makes them more affordable. We price people out of equities. Forcing people to buy overvalued stocks or richly valued stocks means they're going to get poorer returns. If they can buy cheaper stocks, they will get better returns in the future. So so there is an equilibrium price. And what you're arguing is something that a lot of people have argued, what Scott Bessent said too, that corrections can be healthy. That was his answer. And that's what he means. Mm-hmm. He means that we're off of equilibrium, that there is a seller for every buyer. And maybe that if you're an owner of stocks, you don't want to see them go down. But if you're not an owner of stocks and you'd like to buy something that has a reasonable chance of giving you a decent return, you'd like a lower valuation. You don't want to pay through the nose for them, because then you wind up with, poor returns in the future.
Exactly.
So I get that argument. It's not wrong.
Yeah. And like some of those folks, they're probably still in the black, even with the recent, sell-off, because they've probably been in it longer, I suppose.
Which is why it's so surprising. Like a good example of this is Tesla. Mm-hmm. I read again today, will Tesla survive? Will Tesla survive? Why? Its stock price is plummeting. It's down 50%. Okay. But did you look at what it's done? Do you know you know where Tesla stock is now? It's at a 3-month low. It's at a 3-month low. It's at the level it was right before Thanksgiving. And now all of a sudden it's out of business at that level. I get it. It overdid it. It ran up into the inauguration with Doge and Elon's power that he's going to have with the administration, and then it deflated. But it's at a 3-month low. And we're literally acting as if Tesla's going out of business, that it's going to cease to exist as a car company because the stock price is at the same level it was 120 days ago. And, so it's another overreaction is what it is.
Yeah. And oftentimes like the stock market too gets equated to like the economy. I know they're not the same, but they often get put together in conversation. So I kind of want to pivot to the economy because I was looking at prior notes. Jim, you were a no landing guy. I take it you're still a no landing guy. Is that correct?
Yes, that is correct. No
landing. So you don't see a recession ahead?
No, I don't. I don't. And a quick word about what a recession is. In a capitalist economy, the natural state for the economy is to grow. Now, it can grow slow, it can grow fast, but it grows, not recession. 90% of the years since World War II, we've not had recessions. What causes a recession? A recession, I like to joke, and I'm serious about it, is the most unqualified person to tell you we're going to have a recession is an economist. Why? Because recessions are not deep buried in the data. If I look harder in the employment report or in the retail sales report, I will see a recession. Recessions are exogenous shocks to the system that change behavior. Or as the economist Rudy Dornbush famously said, economic expansions don't die of old age. If they did, you'd find it in the data. This is old and it's got problems and it's got, hardening arteries. It's murdered. Murder is a shutdown because of COVID. Murder is a war. Murder is, 9/11. Now, a lot of people have asked, is the murder tariffs? Are we murdering the economy in the recession because of tariffs? Sure, that's a possibility. But I'm under the belief that Trump uses tariffs as leverage. He wants something else. So he puts on a tariff as punishment until you give him what he wants. He wants Colombia to accept a plane load of migrants. They won't accept it. Okay, fine. Starting on Friday, you'll have 25% tariffs on everything that comes into Colombia or comes out of Colombia and exported to the U.S. Okay, we'll let the plane in. He wants Ontario is going to put a 25% tariff on electricity that is exported to Minnesota, New York, and Michigan. All right, I'm going to put a 50% tariff on steel and aluminum until you back off on that 25% electricity tariff. 3 hours later, they back off on it. He gets rid of the tariff on the other side. So he's not using tariffs as a permanent thing. He's using them as leverage. If he uses them as leverage, I don't think that causes a recession. But if he says, I'm going to put a 50% tariff on steel and aluminum, I don't care what the hell happens in the next 4 years, that's never coming off, ever. Well, it destroys the auto industry and it does cause a recession. But I don't think that that's what he's using them for. He's using them for leverage. So that's why I'm in the opinion that no, tariffs are not that murder weapon. And without that, we don't have a recession.
That makes sense. Negotiation, the art of the deal. He wants something.
Yeah, all right, let me ask you. Pure art of the deal. It's exactly right.
Let me ask you this, because you had a great Twitter thread today, and you pointed out, so just for reference, you retweeted White House Press Secretary Caroline Leavitt. She put out, it was a statement from President Trump about the military action against the Houthis. You pointed out in a thread that this post from POTUS can be significant for shipping cost and inflation. I would love to hear more about this event, how investors should be thinking about it, and the implications as it relates to shipping costs and inflation.
So the most important trade route in the world is the one that goes through the Red Sea and the Suez Canal. Prior to the Houthis' attack on shipping in late 23, 12% of all ships and 30% of all cargo went through the Red Sea from Asia to Europe. And by the way, a lot of that is US bound. So they'll put stuff in a shipping container. They'll ship it, to Rotterdam, Netherlands, and then it'll get offloaded onto another ship that goes to the East Coast port in the United States. So It does. It's not just all European stuff, is what I'm trying. It is majority European stuff, but there's a significant part of it that's U.S. Well, the Houthis started, shooting at ships in the Middle East, and ships have started to divert around the Cape of Good Hope around Africa. That adds an extra 3,100 miles and adds an extra 10 days to the trip. That increases shipping costs. Most ships, so people understand, run a liner service. It basically, you have a big container ship. It goes from Singapore to Rotterdam, back and forth, 6 times a year is what it does. Just goes back and forth, filling up with containers, bringing them here, going back with empty containers to get full containers, and just goes back and forth all the time. Well, now it has to go around Africa. So instead of having 6 runs a year, it has 4.5 because it has to go longer. So now I need to engage extra ships to make up that difference. That costs more money. Mm-hmm. That raises shipping costs. That raises inflation. So the U.S. has been trying to fight the Houthis. The Houthis have damaged like 45 ships. They sank a couple of ships. They've killed people. And most high-value ships are avoiding the Red Sea. Container ships, car carriers are, that carry valuable stuff are not going that route. They're going around Africa. The U.S. military, the Navy, has been trying to stop them for a year and a half. But here's the problem. The Houthis use these drones, and these drones can cost like $50,000, right? They're just big airplanes with a couple 100 pounds of explosives. And they might, in some cases, be powered by a propeller in the back with what you and I might look at and go, that's a lawnmower engine. You have to pull start the thing. And they fly it off towards these ships with hundreds of pounds of explosives. Well, we send $1 billion guided missile destroyer, and it shoots a $10 million missile, and we have 100% accuracy in shooting down these ships. Problem is, they have more drones than we have ships with guided with surface to air missiles. In fact, in the last year and a half, the U.S. Navy has fired off more surface to air missiles than they have in the previous 40 years combined. And so they've exposed a weakness. We'll keep firing $50,000 drones with duct tape and lawnmower engines. You keep shooting $10 million missiles with 100% accuracy to shoot them down. We'll bet you'll run out of missiles before we run out of drones. When you run out of missiles, you'll leave. We own the Red Sea. And that's been the case for the last 18 months. What's the fix? Other than the long-term fix is find a cheaper way to do it. But that's the short-term fix is you got to hit the missile sites, right, on the ground where they launch, the drone sites where they launch the drones. Problem is the Houthis use something similar to what the Palestinians use in Gaza, and that they launch these drones, and there's a lot of civilians nearby. And if you try and bomb one of the drone sites, you're going to have collateral damage. So we've been afraid to do that. We've been very afraid to do that, but Trump is not. And he said he's going to get the shipping lanes open by stopping them from doing this. So I understand the political calculus, and I understand that there's going to be collateral damage because some civilians might get in the way. And the Yemeni health authority said that we've already killed over 50 civilians over just this previous weekend. Whether that's true or not remains to be seen. But I'm going to look at it from an economic point of view. If he gets the Red Sea open and 30% of the containers can go through and stuff, that will dramatically lower the cost of shipping. That will dramatically lower the overall goods price. That will dramatically bring down producer price inflation because, especially in Europe, producer price inflation has been somewhat elevated.
So maybe there's the geopolitical aspect as well. If you could bring down those prices for the folks in Europe too, like it kind of makes me think back, and I don't know if my connections are right here, but even when you're mentioning like the realignment part and a lot of these issues, they also come down to like their national security issues too, and folks paying into these, being able to be protected by the military as well, like paying their share. I wonder if it kind of, is there a thread that ties back there?
Absolutely, it ties back to that. If we open up, I don't think that it's a coincidence that he's trying to open up the Red Sea. Obviously, it's the big choke point right now. And what has been the argument that we have been making, right? We have $36 trillion of debt. Where did we get most of that debt? Well, for decades, that was fighting communism, fighting terrorism, funding the Ukraine war, the Gulf wars, all of that stuff. And we've been the lead and we've spent the most amount of money, and our budgets have been 4, 5, 6% military, where in Europe they've been 1 or 2% military. So we've kept the world safe. We've racked up a lot of debt. That debt, as I said before, is now a national security issue. So we're going to turn, this is the argument, we're going to turn to them and say, look, you owe us, man. Here's a bill. Here's a bill. Pay this bill for security. And believe it or not, Europe has said, well, we agree. We're going to pay for security, but we're not going to pay you. We're going to spend trillions. Europe, are going to spend trillions of dollars on security. We're going to bring up standing armies. We're going to buy ships. We're going to buy planes. We're going to buy guns. We'll do it. And the theory is, well, okay, if you do it, then we could do less of it. We don't have to be the cop of the world. You could be part of the cop of the world as well, too. There's issues there in Europe because they've got diverging interests. Spain announced today in the FT that they're going to greenwash. Oh, yeah, we got this green initiative. We're just going to call it defense spending. And that doesn't sound like you're buying guns and planes with your defense spending. You're just going to do more green stuff as well. But then on the other side of the equation is you got Poland. Poland says, we're going to have our own 500,000 man army, and we want the French to give us nuclear weapons because we share a border with Russia and we got to protect ourselves against Russia. Whoa, they're starting to sound really hawkish in Poland. So there's not, so the Spanish are all in on defense spending because they want to use it to spend on green initiatives and call it defense spending. But the Poles, they want nuclear weapons pointed at Putin, and they want 500,000 men standing on their border to keep the Russians out. So they've got two polar opposite views of what defense spending means, is what I'm trying to bring up. But nevertheless, that's part of what we're starting to go towards, is a lot of our debt has been security. And now the argument is the bill to pay. And that bill to pay, like I said earlier, look, you could go back and you could say with the status quo in our country, well, we should have the rich pay for it. They don't have enough money. But there's a bigger pile of money, and it's the rest of the world. Send them a bill for defense. And that's what we're doing. Now, part of that could be you open up the shipping lanes in the Red Sea, and then, you lower the inflation costs for Europe, and then you turn to them and go, you owe me. You owe me a lot for doing that for you. We did that for you. And so that's part of this whole thing right now.
Jim, I have to say, I love having you on this show. This audience always loves having you on because you always get us thinking about new ideas. Before I let you go, I want to pass it back to you. Let folks know where they can find you, follow your work. I know you are all over social media. You also have an ETF as well.
Yeah.
And feel free to plug that. Any parting thoughts, anything that you'd like to leave this audience to think about? The floor is all yours.
What I'm trying to emphasize is, if we're in a fourth turn and if the status quo can't hold, we're going to go forward with some kind of a realignment. That is going to be a period of change. But, if your question is, how do we realign the world, reorient everything, fix the debt problem so that the VIX stays at 12, the S&P goes up, 10%, 15% every year, and everything is, I don't notice it and it just keeps making me money. That world doesn't exist. And so we're in a period of trade-offs right now. And that's where we're going. Now, you can argue that they've got the wrong approach, but they got 81 million votes and they've got the cabinet lined up and they're going to go this way. So first of all, they're going to do it. But if you also want to argue they got the wrong approach, you can't do like the Economist magazine and just say, stop, just stop. We're not going to go back to where we were before. You have to say, don't do it this way. Do it a completely different way that we've never done before. And that's very difficult for people to understand. And a lot of people are still trying to get their head around, are we really doing this? Or is this kind of just, new administration comes in, they beat on their chest to try and do something bold and initiative, and then the market falls and then they cower in the corner and they stop all of it. I don't think he's going to stop all of this. So that's my bigger point, is that we got to start thinking about that bigger things are going on, and it's going to require a detox. It's going to require an adjustment. That's what Trump said at the State of the Union, or what we called the State of the Union, is that we're going to see an adjustment. And that's what we're seeing in markets right now. And I'm arguing here with 5% bonds and 6% stocks, and 4% would be what I think money markets will return. It's not going to be disastrous, but if you're in the number go up and everything flies through the ceiling, we're not in that environment anymore. So that's what I've been trying to emphasize to people, is that this is a different environment. We got to start thinking about this stuff differently. And I want to emphasize again, if you don't like it, you can't just say bad idea, because what you're saying is go back to the way we were a year ago, go back to the way we were 6 months ago. That's not possible. So if you say, I don't like it, what should we do? And hint, tax the rich, do different types of baseline budgeting. That's the shit that got us in trouble in the first place. That's not going to work. You got to try something else. And so that's really what I'm trying to emphasize. Now, socials and everything else. BiancoResearch.com is my research business. Bianco Research on YouTube, Bianco Research on X, Twitter, Jim Bianco on LinkedIn. We also manage, because I think the fixed income markets become very interesting, we manage a fixed income total return index. We manage an index. S&P Index Committee manages S&P 500. And Wisdom Tree, our partner, has a ETF, WTBN, Wisdom Tree Bianco Nancy, that tracks our index, or BiancoAdvisors.com to learn more about our index. You're interested in the bond market, you want to own some of your assets in bonds, and you're not exactly sure how to do it, that's what we've structured our fund for. So it's Bianco Advisors, WTBN, or Bianco Research. Follow me on most of the socials. I talk about a lot of these bigger picture issues.
I love it. I will certainly link all the socials for folks who are watching and listening in the show notes. And Jim Bianco, president of Bianco Research, thank you so much for being so generous with your time, your knowledge, all of your wisdom and your ideas, and for just helping us all learn and get better. Really appreciate you. And I hope you have a wonderful rest of your day out in California. And until next time, be well, Jim.
Thank you. And thank you to Winston, too.
Yeah, for sure. I know your cat's made an appearance before on the episodes.
Right.
So yeah, thanks, Jim.